Hey everyone, welcome back to the channel. In this video, we're talking about the potential for a stock market bubble. Now, I don't want this to come off in any way of fear-mongering or trying to scare people because I own most of my stocks. I still have them and I'm not really planning on selling. But I wanted to provide some different indicators that I've noticed over the past couple of months that I thought would be important to share with you here today in this video. And I apologize, I haven't made a YouTube video in almost a month now. I've been busy working on some different projects, but I've had quite a few requests for people to ask me to talk about the stock market, especially talking about some of these crazy valuations that we saw with GameStop and AMC last week. But let's get into it. Let's talk about this and talk about the potential for a market bubble. But as always, I want to try to give an as almost unbiased viewpoint as possible here to give you both sides of the story, because there are plenty of reasons why the market may continue to climb in 2021, but there's also some concerns that people might have. And I'm not here to be a guru to tell you what stocks to buy and what stocks to sell and that the world's going to collapse and everything's going to go to zero. That's not what I'm here to tell you, but more so just to share my opinion to a camera here in my living room. Just talking to a camera kind of feels weird, but nonetheless, let's get started here. I first want to show you this interesting chart that I think everybody should understand pretty well. And this is not something that I created. Somebody, I believe, at Hofstra University created this chart. But it really gives 4 different phases of financial markets and bubbles and how these bubbles can form. And so you can go ahead and look through this and maybe even pause the video or just let me explain this here of each one of these different phases and how we can be affected from these. So we have the stealth phase, which tends to be smart money, right? This is the point in which everybody would love to get into an investment in the stealth phase, the early phase. This could be starting your own business. This could be a venture capitalist investing money into Facebook in 2004, right? It's very unlikely to get into a phase like this, but it is still very possible to get into markets at a time like this. Imagine you're investing money into companies back in the fall of 2008 when everybody else is selling, or perhaps you are investing into companies in March of 2020 when the markets were down about 40% because everybody was panicking. This tends to be the stealth phase or the smart money phase. A lot of people don't end up in this, including myself, and that's okay because you can still get in at what's known as the awareness phase, or this is what a lot of institutional investors can find themselves getting into. We kind of call this like the Wall Street area, where a lot of Wall Street investors might get into this, but it's still not in the mania phase. It's still not in the point where everybody and your brother and your brother-in-law and everybody else that you know, like your plumber comes in to fix your pipes and they're talking about the stock that everybody's buying, like what we saw with AMC and GameStop, which we'll talk about in a couple of minutes here. But what we have here in this awareness phase, this could be another great time to get into a company. I actually happened to buy AMC stock a couple of weeks ago. It was really low. It was like $3 a share. This was lucky. I mean, I was in the right place at the right time, so I don't want to sound like I'm a genius because I've made plenty of bad investments as well. But I got into AMC before it hit the mania phase. I was in AMC in this awareness phase where it started to build up, saw things brewing on Wall Street bets, and so I made some investments into a company like that and then wrote it up a bit. And like I said, I made plenty of bad investments, so I don't want it to sound like I'm righteous or somehow better. But anyway, then we enter into the mania phase. And I want you to look at some of these words here that describe the mania phase and ask yourself if you or people around you tend to find yourselves in this category. It's difficult for us to say that we're in this sometimes, but it's something that I think we need to do some self-reflecting on, especially when looking at certain securities. But in this mania phase, we have media attention, right? Massive media attention. Everybody's interested in investing. We have this huge amount of enthusiasm, greed, which leads to delusion, which then ends up at the peak. But let me explain to you why I believe we are somewhere in this phase of mania. And I can't tell you precisely where we are because, to be honest, people could keep driving this up even higher. We could end up doubling the prices of some stocks. I, quite frankly, just don't know the answer to this of when a bubble might pop or if we are even in the full bubble at the moment or just starting to approach one. Now, real quick, a word from our sponsor for today's video, which is Morning Brew. This is an email newsletter that comes into your inbox Monday through Saturday. It's something that I genuinely look forward to reading every morning when I wake up. Before using Morning Brew, I was browsing around social media, sort of aimlessly going through social media. But now, while I read this, it helps keep me up to date with things that are going on in the world at the moment. So I love starting my day with this. It's a totally free daily newsletter that you can get into your inbox and get you up to speed on business news in just 5 minutes. And generally speaking, traditional news, it can be sort of dry, not very exciting. But with Morning Brew, I love how exciting and funny they make some of these articles and extremely relatable just to people like you and me. So we can digest this very easily, but also really genuinely look forward to reading this and staying up to date with what's happening in the world. So for example, in the past couple of weeks, I've been keeping up with this GameStop and AMC craze and look at the what's happening with Wall Street bets. And Morning Brew would keep me up to date with that so that I didn't have to sift through hours of different content trying to figure out what was happening. I was just able to read the Morning Brew newsletter and get a pretty good understanding of what was happening thanks to them. So there's really no reason not to subscribe to Morning Brew if you're interested in business, finance, or tech. It's completely free and takes less than 15 seconds to subscribe. So you can go ahead, click the link in the description below to subscribe to Morning Brew today. Thank you for sponsoring this portion of the video, Morning Brew, and let's get back to the content. So let me explain why I created this video in the first place. It's because as a financial influencer, I suppose I could call myself, I get quite a bit of data on the back end to look at the search traffic, to see the amount of search traffic that we get for specific terms related to investing. And we saw that between mine and others in this industry, whether they're bloggers and they own the different search terms for how to invest or investing for beginners or stocks to buy, we see that overall, after averaging all this together between myself and a number of other influencers and bloggers and other types of media content, we found that search traffic was up about 310% since October of 2020. 310% since October of 2020, search traffic related to investing and stocks and the stock market. And the reason why I wanted to bring this up, and the reason why I think we are getting into this phase that maybe we're still in this awareness phase, maybe we still haven't gotten anywhere near this bubbly phase yet, but I wanted to bring this to your attention because it's been brewing in my head for the past couple of weeks and how I could present this. But when we see something like this happen, when we see a massive influx of people very interested in jumping into the markets, a lot of them because of FOMO, fear of missing out, where they saw their friends make a lot of money in 2020, or they saw their friends make a lot of money in the past 10 years and said, you know what, I need to just jump into the markets and dump all my money into the stock market. The reason why this is important to recognize trends like this, to recognize massive influx of money dumping into the markets, is because it goes with the basic laws of supply and demand, right? And you know that maybe I talk about this too much on my channel, but I really think almost anything in business can come back to the basic supply and demand curve. I'll give you an example here of why this is important and how this can really drive up stock prices and in some cases create overvalued assets and securities. Let's say that I'm selling a house, right? Just keep this very simple. Let's say that I'm selling a house and there are 10 prospective buyers of this house. 10 people are thinking about buying this house, right? Maybe they bid against each other a little bit, but there's not too much bidding, and I end up selling the house for $300,000. Okay, pretty nice, right? Sold the house for $300,000. At least I had 10 prospective buyers. That's great. But let's take a different scenario where maybe there's 30 prospective buyers. There's 3 times more prospective buyers of this house. So with 30 people looking at my house wanting to buy my house, what happens? Well, they're probably going to bid against each other even more. Chances are there's somebody in that group of 30 people who wants that house a lot, and so they might bid against each other. And maybe I can sell that house for $350,000 or $400,000 or $500,000 because there's more bidders, there's more competition. And so I think this is in some cases with some stocks, not the overall market as a whole, but some specific securities. I think this is almost what can be happening, and maybe sort of still on a relatively small scale, but when there's so many people jumping into the markets, it drives up the price of stocks. Now, being totally transparent, I'm a Tesla shareholder, but starting to look at some of these valuations, they can get very, very lofty when the PE ratios are well over 1,000, and when we start to see some of these different things. What happens here, and the concern here is that essentially what happens now is basically if anything goes wrong with a company like Tesla, if they don't hit the numbers that they are projected to hit with this price to earnings ratio so high, if they even slightly slip up, we can see that stock price come down very, very quickly. And that goes for a lot of these other companies as well that are talking about going to space and going to a different galaxy and starting like farms on Venus or something. Just random companies that are going out there and making these crazy claims and suddenly getting boosted and driven up. So a fun little stat that I learned the other day is that Tesla is valued at $1.5 million for every car that they sell versus a company like General Motors, which I believe is like $9,500 per car that they sell. All this being said, yes, I still own Tesla stock, but it almost feels like it's Amazon stock 1999. Great company, probably going to succeed long-term in the future, but things are kind of lofty right now at the moment from my personal opinion here. But looking at all of this different data, looking at all these different problems, what are some other concerns that people might have? I've heard people throw around the idea that, oh, well, corporate taxes are probably going to increase under Joe Biden. I don't think this is really something to be concerned about because it's probably already factored into the markets. So even if corporate taxes go from 21% to 28%, yes, that might end up hurting corporate earnings maybe by 10%, give or take, just a rough, quick and dirty estimate there. But that's probably already factored into the markets, so that probably wouldn't be something that would spur some type of big sell-off in the markets. But really at the end of the day, I think it comes down to seeing so many people totally disregarding fundamentals, disregarding balance sheets, cash flow statements, financial statements, and just buying something simply because they think that somebody else is going to pay more for it, and not because they think it's actually a security that can end up performing well over time and is a healthy company. And I think anytime in history when you see something like this happen, this is when there should be some room for concern or reason for concern here. So the goal here is to get out of stocks before they start to deflate. How can you do that? It's very difficult to say, but overall, what I think people would want to be doing is getting in at the smart money phase, getting in at that where institutional investors might be even, and then selling off before we hit the total top. Everybody says buy low, sell high. It's so much easier said than done. And so I'll give you an example here. I actually made this mistake as well, where when this AMC craze was going on with GameStop and everything, like I said, I got in around $3 a share. I wrote it up. At one point, it was at something like $20 a share, and I got a little bit greedy, and I started to put in more money and more money. Luckily, I still ended up with a pretty decent profit, but I sold AMC at around $16 a share and lost a little bit from what it could have been if I wasn't so greedy. Now, let me just quickly show you the Shiller PE ratio. I don't really think that this is going to be the most useful chart to look at, and I'll tell you why. So first of all, understanding the price to earnings ratio and understanding how that can affect stock prices and why it shows the potential growth for companies. Look, even though that the Shiller PE right now is about 35, and historically that is pretty high, I remember watching YouTube videos 3 years ago from people back in 2018, back in 2016, back in 2015, who were looking at the PE ratio, the Shiller PE, and saying, well, we're pretty high because look right here, back in 2015, the Shiller PE was at about 25. And so some people looked at that and said, oh, don't buy stocks. Don't buy stocks, just keep your money in cash. And look how that turned out for them. I mean, they missed out on a tremendous amount of gains that they could have had if they were just looking at something like this. So even though it's important to look at overall PE ratios, it's not going to be everything because there's different factors that are going to be affecting this. And I think at the end of the day, when we look at the markets and our options for where do we put our money, because everybody says savers are losers. Having your money in cash is a losing position. I believe that. I don't like having just money in the bank. I like to deploy it and put it into something that I know can grow, especially considering the fact that the government's printing trillions of dollars and the dollar is getting totally devalued. So how do we keep up with something like that? And that's what we're going to lead into here. The overall consensus of this video, what I'm doing personally. Look, there's a couple of things. First of all, be very wary of these bubbly areas. I really think that there are some bubbles in here. And I don't want to sound like a financial advisor because I'm not. I'm just a random guy talking to a camera here. But be very careful with some of these things that have crazy high, lofty valuations based off of no fundamentals whatsoever, but just the hype of the internet, just the hype of CNBC and Jim Cramer going out there and just telling buy, 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 buy. So be careful with that. Stick with the fundamentals. I'm constantly looking at the core fundamentals and the health of a company. And even though some people are saying Warren Buffett is obsolete because he's focusing on investing into companies that are very steady, slow growing companies, companies. I would rather do that over a long period of time rather than jumping into companies that might have crazy high valuations that could totally pop tomorrow. So the overall consensus here, where do you put your money? Where do I put my money? Like I said, can't tell you where to put your money, of course. I'm staying away from bonds. I think bonds are totally overvalued right now at the moment. When you look at the rates that you can get with bonds, it's very simple. When you look at the rates that bonds are yielding right now, maybe you can get a couple of percent on certain types of bonds, corporate bonds, municipal bonds, but at a couple of percent, and then they also have this risk of defaulting. You sort of have to ask yourself, is this really worth something putting money into if you're getting a 2% yield and then that company or that municipality or that government might default on it? I really don't think there's very much value in bonds. So if there's not much value in bonds, well, putting money in cash also isn't going to be very effective either because, let's be honest, I mean, you might get 0.5% on a CD, maybe money market, you might get close to 1%, but interest rates are low. The Fed already said interest rates are probably going to be low for at least the next couple of years. So having money in cash, especially with the amount of money being printed right now, doesn't make very much sense either. So what does that leave us with? It leaves us with the stock market or different types of investments like real estate perhaps, or even cryptocurrency. I'm doing all three of those there going forward in the future, because even if the markets perform worse than what they performed in the past decade, even if the markets only grow at 5% per year for the next 10 years, that's probably still going to be better than bonds or cash. And so that's why I'm still sticking with the stock market. I'm not selling many of my stocks. I am relocating some of it. If you watch my plan for investing for 2021, you know that I mentioned that I'm going to be shifting some of my money out of some of these big tech companies and into some of these more traditional utility, energy companies, ones where people aren't really looking at them, right? They're also focused on these new companies going to space, and instead they're not looking at the companies that are churning a decent profit. All right, so that's the video. Thanks for watching. I hope you enjoyed it, and I'll try to make more videos. I think we're going to be rolling out a lot more videos this month. I'm feeling good. I'm going to start cranking these videos out, and let me know what you think. If you have any video suggestions down below, let me know, and I'll make them next week.